Michael Cox. He's a former chief economist for the Federal Reserve Bank of Dallas. And Michael, thank you for sticking with us. I was really interested when the Fed chair actually was talking about inflation, and he made the point of saying that things like cars, new, used, and rental cars have moved up in price because of the semiconductor shortage, but that those things don't carry significant implications in the long run for the American economy. Can you help us understand? Because I would imagine there are some people, we just posted a story today, the average new price of a car broke $41,000 for the first time in history in the United States. And I think some people would say, what do you mean no long-term implications? Oh, I think you might be muted, Michael.
Economists always make a distinction between once and for all price changes, one-time price changes, and continuous price changes, which are inflation. So those would be once and for all price changes. The Fed's job is to control the continuous price changes, and which come from too much money growth chasing too little GDP growth. Now, I thought what Chairman Powell was doing today was really smart. He was trying to control inflation expectations before they get incorporated into long-term interest rates for things like mortgage rates, bond rates, corporate borrowing rates, bank rates, and so on. And what he said to me that was the most encouraging, I would think, to markets, he said, we are actually responsible for this, and we will react. It's our job to react. We know it, and we will react. And if you look back at history of the Fed in the 2008 recovery, recession, the Fed pumped money into the economy. Inflation got up to about almost exactly where it is today. Over the past 12 months, it's been 5.3%, which is the highest it's been since 2008, when the Fed was trying to help with that recovery. What happened after that? Did the Fed cut back on money growth when the economy started to recover? Yes, it did, and inflation came way down. They got it back down to target growth rates. In fact, even inflation below those target rates, one time it was running at 0 to 1%. So the Fed did a good job of pulling back from the money growth and getting us back to low inflation rates again. And so he said, we know what's going on. We're not going to go back to the days that where Volcker had to wean the economy from inflation, but this is not that Fed. You can count on it, is what I heard him saying. So, be sure you understand we're not going to let this inflation hang around and get incorporated in long-term rates and you're not going to have to fight the inflation bear like we once did in the past, because we know that it creates long-term effects which are bad for an economy too. I agree with everything Mark said that we're not out of the woods here yet. This recession, this sluggishness in the economy is likely to persist for a while, and that's unfortunate because I had hoped, we all had hoped that 2021 would be a strong recovery year, which would give the Fed and give policymakers some ability to back off on money growth. Unfortunately, I think right now, fiscal, and a lot of people believe, that fiscal policy has been kind of getting in the way of recovery by slowing labor force growth, keeping people from getting back to work. We're not going to be able to get back to this new economy we have, whatever that is. As we transition from the pre-COVID world to the post-COVID world, it's going to be different. How different, I don't know, but somewhat different. How long it's going to take to experience this new economy, I don't know. It's going to take a while, but the only way to find out what that economy is to let those people get back to work, experience what new jobs are out there. You can't do it when people are sitting on the sidelines with a government check.
Well, Michael, I wanted to ask you a little bit about the dynamics that are at play in the labor market right now, because Powell made a few comments on that. He was saying that it's a very unusual situation that the ratio of vacancies to unemployed be this high. Of course, there were lots of questions about how much the enhanced unemployment benefits were playing into the fact that people were staying on the sidelines. Yet we haven't really seen people jump back into the labor force from some of those states that have ended the enhanced unemployment benefits early. Why do you think that is? And I guess, how long do you expect it to take in order to correct some of the lag and some of the problems that we are seeing in the labor market today?
It's a state by state matter, depending on just how generous each state is with unemployment benefits. Some states have cut off the unemployment benefits, and in fact, most of those states you'll find people getting back to work. And when I drive around Texas here, and we talk about it, There are help wanted signs everywhere. Now hiring. When I talk to folks, they said, when I talk to employers, they say, I can't get people to come back to work. And we all talk about it. It's very difficult to get some folks to come back to work now, but they're starting to, because, the government payments for being unemployed are running out. Listen, I know it's hard for people. We all know it's hard for people, but, it was hard for people during, the Great Depression but people had to discover that when they went to and transitioned from the days of agriculture to the factories, that they had to discover that old job that they were looking for is no longer there. And until they got back into the labor force and they went looking for it and found that it wasn't there, and then they went looking for that next job that was there, they couldn't get to the new economy. That's what we're in right now.
All right. Got to say thank you so much to Michael.